Hello, everyone, and welcome to Unacademy, India's largest online learning platform. And welcome to my special class today on the Indian Partnership Act 1932, Part 1, where I will be covering the important concepts of the Indian Partnership Act 1932. Let's start off. A little introduction about myself. Hello, friends. I'm Prathik Gupta, a Bachelor of Commerce from Christ College, Bangalore University, an associate member of the Institute of Chartered Accountants of India, an associate member of the Institute of Company Secretaries of India, an associate member of the Institute of Cost Accountants of India, a law graduate from Karnataka State Law University, and currently a practicing chartered accountant. I'm also a visiting faculty in institutes taking CA subjects as well as teaching CA students online and offline. Prior to starting my own practice, I worked with SR Bartley Boy. That's the Indian member firm of Ernst & Young Global in the audit and assurance department. Post that, I worked with E&Y in the mergers and acquisition department. Then I quit and joined the industry in the Manipal group and was the corporate controller of the German entity in Frankfurt, where I was stationed there for a couple of years. So that's a brief introduction about myself. Welcome to Unacademy. What do you get when you subscribe to Unacademy? You get daily live classes on the subject that you want the most. You can handpick the topic and the subject and the educator that you want from the various resources that Unacademy provides to you. You have live tests and quizzes to know your level of understanding and where do you stand, so that you can identify your areas of improvement and take corrective action on them. Unacademy provides you structured courses on whatever topics you want so that you do not miss any point that is important to you and also important for your preparation for various exams that you're looking for. And most importantly, Unacademy gives you unlimited access to the various resources and content on the Unacademy platform for you to use whenever you want, at your convenience, at the ease of your fingertips, at any time of the day. So once again, I welcome you to Unacademy. For the people who have not yet installed the Unacademy app, I request you to go to your Play Store and download the Unacademy app, learning app, which will give you a gateway to the various resources of all the matters and topics that are present on the Unacademy platform. So Unacademy provides various subscription plans. So currently for the CA Foundation and Intermediate subscription plan, Unacademy provides you a 1-month plan, a 3-month plan, a 6-month plan, a 12-month plan, and a 24-month plan. While you make the choice of your subscription, please do not forget to use the code Prathik, that is PRATHIK, to get a discount of 10% on your subscription. So let's come to the topic of the day. I welcome all the viewers and all the participants. Thank you very much for being here. And please feel free to share your experiences and ask questions if any. I will be happy to answer them. So let's start off with today's topic, Indian Partnership Act 1932. So before we start off with the topic, let's try and understand the various forms of organization that is present in India. Now, what are the various forms of organizations that are present in India? A proprietorship, a partnership, a private limited or a public limited company. Collectively, it's called a joint stock company, an association of person, a trust, or any other form of organization. So what are the advantages and disadvantages of each and every kind of organization? Let's start off with that. Firstly, with a proprietorship. As the name says, a proprietorship concern is a one-man concern. It's not a firm. Please remember, it's called a concern. So it's a proprietorship concern. A proprietorship concern is run by one individual. He takes all the risks. He takes all the rewards. He controls everything, and he is the final authority in the organization. Now, while it's got its own pros and cons, the cons are a little bit more than the pros. Now, let's start with the advantages of a proprietorship concern. Firstly, it's easy to set up. Secondly, it's inexpensive to set up. Thirdly, the proprietor has ultimate control over the affairs of the organization, and he has basically everything at the back of his hand. Now, let's come to the cons of it. Firstly, because it's a one-man show, there is a lack of expertise. There are not many people or not many owners involved in the organization, and that's the reason why there is a shortage or lack of expertise that comes into a proprietorship concern. Secondly, there could be shortage or a lack of financial assistance. At the end of the day, how much can a single person pump into a proprietorship concern? There has to be a limit to it. He can take care of the losses for maybe 2 years, 3 years, 4 years, but there will be a point wherein he will have to take a decision whether he can carry on in a proprietorship concern or he needs another person to invest in his concern. The third part is control. Obviously, if it's a proprietorship concern, one person can control it, but for how long? Initially, when the business is growing up, it's okay if you have control over the organization. But as the organization grows, the verticals grow, the work grows, then in that case, you need to have various verticals and various co-owners in the company who help you run the company. So this is the disadvantages and advantages of a proprietorship concern. Now, let's look at a private limited company. What is a private limited company? A private limited company is a company which is either a private or a public and has shares in which the public or certain people invest. If you have read company law, a private limited or a public limited company is a separate legal entity that is separate from its shareholders and directors. It is a completely different and distinct entity that comes into existence. The advantages are, yes, it gives you a professional look. It is governed by the Companies Act 2013. So there is some sort of a mechanism, a governance present in such kind of organizations. Then you also get financial assistance in terms of shares and banking channels and everything like that. But on the other hand, the cons of that is it is expensive. The compliance costs are more. So if you notice, every kind of organization has its own advantage and disadvantage. So now let's come to the Partnership Act. Now, what does the Indian Partnership Act 1932 govern? The Indian Partnership Act 1932 governs the partnership firms. Now, what is a partnership firm? Partnership firm is where two or more people having a common objective come together to carry out the common objective and fulfillment of a common objective. So when two or more people come together and form an entity, that entity is called a partnership firm. So in the Indian Partnership Act 1932, please note we will be talking only about an unlimited partnership firm. For a limited partnership firm, there is another topic which I shall be taking in future that is called the Limited Liability Partnership Act 2008. That subsequently was enacted in 2008. But what we're going to talk about now is Indian Partnership Act 1932. Hello everyone. Hello Shikha. So if anyone has any questions, please ask me. So let's start off. The law of partnership is contained in the Indian Partnership Act 1932, which came into force on 1st October 1932. Okay. A contract of partnership is a special contract where the Partnership Act is silent on any point. The general principles of the law of contract apply. So what does this mean? Please remember, for any partnership firm to come into existence, there is a very important document which is known as a partnership deed, which spells out the roles, responsibilities, duties of all the partners in the partnership firm. So if there is any point that is missed out in the partnership deed, please remember that particular topic or that particular area will be governed by the Indian Contracts Act 1872, the session which I took on yesterday and day before yesterday, part 1 and part 2. So for the people who missed it, can actually go back to the archives and see my session on Indian Contracts Act 1872. So any point which is missed out by the partnership deed, please remember your partnership deed governs how the partnership firm works and what are the roles and responsibilities, duties, functioning of the various partners of the partnership firm. When a partnership deed is made, it is kept in mind to keep it as explanatory and as explicit as possible so as to avoid any vague interpretations or scope for any unfavorable or favorable interpretations in favor of any partners. So this act extends to the whole of India except the state of Jammu and Kashmir. Mr. Sunil, sir, exception nahi. After Article 370, please note that there are still a lot of transition provisions going on. So in that case, there is still a gray area. So until and unless the gray area is cleared, the act extends to the whole of India except the state of Jammu and Kashmir. We still need clarifications on that. Okay, meaning and definition of partnership. Section 4, para 1 of the Indian Partnership Act 1932 defines partnership as: partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Thus, partnership is the name of legal relationship between or among persons who have entered into a business. So, let's dwell a little more about this. Now, what do you mean by the definition of partnership? Like I said earlier, partnership is a relationship that has occurred or arisen between two or more people who have agreed to share the profits of a business, which is carried on by all of them or carried on by one of them on behalf of all of them. Now, what document or where is it written out that who will carry out the business, how much will he carry out the business, and what will he do? This is contained in the document called a partnership deed. Please remember, if there is no partnership deed, there is no partnership firm. So a partnership deed is of utmost importance in terms of a partnership firm. So like I said in the definition, please note that there are two or more people coming together to carry out a single or a common business activity which they have agreed upon, and that business, and to share the profits and losses from that business activity, whereas they agree that either all of them will carry on the business or one of them will carry on the business on behalf of everyone. So like I said, when it's two or more people, partners can be many. So there can also be a case where all the partners carry on the business of the partnership firm. One person takes care of operations, one person takes care of marketing, one person takes care of production, one person takes care of finance, one person takes care of another vertical. So in that case, all the partners jointly carry out the business and share the profits and losses in the agreed format or agreed ratio that they have agreed in their partnership deed. So thus partnership is the name of a legal relationship between or among persons who have entered into a contract. Yes. Any questions? Please feel free to ask. Now we come to the next important topic: nature of partnership. A partnership is an association of two or more than two persons. Like I said, a proprietorship concern is one person, whereas a private limited company whereas your private limited company has also its own advantages, but the compliance cost is more and can have many shareholders and directors. So a partnership firm is where two or more people associate or come together for a common objective. A partnership firm is a result of an agreement between two or more persons. Like I said again, the utmost important document in the partnership is a partnership deed, which carries out the roles and responsibilities, functions and duties of all the partners and the partnership firm. An agreement must be to share the profits of the business. Your partnership deed should clearly mention the ratio of profits and losses that each partner has agreed to take or contribute. Business must be carried on by all of them acting for all. Now, what do you mean by this? Please remember, all more than two people come together to carry on one business. So it has to be a common business. So when I say common business, it need not necessarily be one business. It can be more than one business. It can be a business of furniture, whereas it can also be a business of computers. But whatever the business is, it needs to be written down or mentioned in the partnership deed that these are the businesses that the partnership firm intends to carry out, and they must carry out their business activities according to the partnership deed. Either all the partners carry it out or one of them carries on behalf of all of them. That authorization is also given in the partnership deed. Unlimited liability. Okay, now this is an important concept. Now I would request people to pay attention to the concept of unlimited liability, because this concept is what differentiates the Indian Partnership Act 1932 from the Limited Liability Partnership Act of 2008. Unlimited liability. Let me take an example. Let's say A and B come together to form a partnership firm. They contribute 50 lakhs each, 50,000 each into the partnership firm. Let's call it A, B and Co. They contribute 50 lakhs capital, 50,000 capital each. So the total capital of the partnership firm is 1 lakh. Now, in the process of carrying on the business, they were carrying on the business of furniture. So let's say they bought wood and hardware items from dealers all across Bangalore to carry on their production activity. So the business went on smooth for a couple of years. They made good profits. A and B shared the profits in 50-50%. But suddenly COVID struck. Now COVID struck, there was no business, or the business came down, but they had bought a lot of goods from the vendors for which they had to make payments. So the vendor waited for a couple of weeks, couple of months, but please remember the vendor also has to take care of his livelihood. So let's assume that they bought goods worth 5 lakhs from the vendor. So for 2 months, the vendor was unpaid. After 2 months, the vendor came and sat on their head and they said, no, I want my money. So initially they said, okay, sir, give us a couple of weeks and we will pay you the money. But A and B could not pay the money because there was no business. The business was shut down. Now, in this case, what happens? Please remember the capital of the firm was 1 lakh. So whatever money was in the bank, of the partnership firm was given to the vendor. Let's call the vendor C. So C got whatever money was in the bank of A, B, and Co. Let's say they had only about 2 lakhs to pay. So 2 lakhs was paid to him. But what was the amount of goods that was purchased from him? The amount of goods that were purchased from him were 5 lakhs. So what happens to the remaining 3 lakhs? Now comes the important concept of unlimited liability. The amount of 3 lakhs can be recovered from the partners from their personal assets. Now, when I say personal assets, what do I mean? Personal assets could mean their personal bank balance, their personal property, their personal assets in terms of jewelry, in terms of car, in terms of building, in terms of FDs, in terms of whatever they own. So if the vendor C goes and files a case against them, the court can order them to sell off the jewelry, sell off their house, or sell off any assets and repay the amount of 3 lakhs to C. So in this case, please note that their liability is unlimited. Even though the capital of the firm was 1 lakh, they purchased items worth 5 lakhs and they repaid the vendor only 2 lakhs. So 3 lakhs was still remaining from him. So in that case, the 3 lakhs can be recovered from their personal assets by selling off the house, their car, their FDs or whatever, and they can recover the money. So this is one of the major drawback of a unlimited partnership which is registered or formed under the Indian Partnership Act 1932. I hope you're clear about the concept of unlimited liability. If not, you can please ask me any questions. I'll be happy to answer them. Any questions? Okay, let's move on. Restriction on the transfer of interest. Now, what do you mean by restriction on the transfer of interest? Now, let's say A and B are partners in a partnership firm, and A and B share profit and loss in the ratio 25% A and 75% B. Now, restriction on transfer of interest simply means that both the partners cannot transfer their 25% and 75% to another person outside the entity without the permission of the other person. Now, what happens if they do that? Now, in case B transfers his 75% interest in the firm to another person, C outside, suddenly what will A realize? A realize that B is no longer his partner and there is a new person that has come into the partnership firm. So now A and C become partners. So that makes it a very scary situation and a very inconvenient situation. So to avoid that, the Indian Partnership Act 1932 restricts the transfer of interest of the partners among themselves without the permission of each other. The next point is unanimity of consent. Unanimity of consent simply means whatever decisions are made in the partnership firm, normally, unless otherwise agreed upon in the partnership deed, the decisions are made unanimously by the consent of all the partners in the partnership firm. Even if one partner does not agree to it, the decision cannot be carried ahead. And in case that is carried ahead, the dissenting partner can go to seek legal remedies. So, unless until agreed otherwise in the partnership deed, there has to be unanimity of consent in the decisions of the partners of a partnership firm. Agreement must be to carry on some business. Like I said earlier, obviously a partnership cannot be made just for anything. It cannot be done just for any fun activity. It has to be done for some business activity, and the business activity has to be a lawful and legal business activity. A partnership deed or a partnership firm constitute to carry any illegal or unlawful business activity is void and will not be allowed to carry. So care needs to be taken when an agreement is being made for a partnership thing, which is called a partnership deed. I hope I'm clear so far. Any questions, please ask me. I welcome all the viewers. Any questions, please ask me. Let's proceed. Now, what are the essentials of a partnership? A partnership is an association of two or more persons. Like I said again, Two or more people come together to carry on business and to share the profits and losses. So a partnership is an association of two or more persons. A partnership must emerge out of an agreement. Like I said earlier, a partnership deed is of utmost importance for a partnership firm to come into existence. The business to be carried out must be legal and acceptable by law. Yes, the partnership firm cannot be made to carry any illegal or unlawful business. It has to carry out, or it has to be formed to carry out a legal and lawful business that is acceptable by law. The agreement must give all the essential details of partnership, that is profit sharing percentage, business to be conducted, etc. If you get a chance to look at a partnership deed, please remember it will give you all the important information pertaining to that partnership firm. Information like name of the firm, the address of the firm, who are the partners of the firm, the name and addresses of the partners of the firm, what is their profit and loss sharing ratio, what is the capital that each partner has contributed in the firm, what business the firm intends to carry out, and what are the other ancillary activities the firm intends to carry out to support the various businesses it wants to carry. So a partnership deed will give you comprehensive information. It will also give you information about who is authorized to operate the bank account of the partnership firm and who is not authorized to operate the bank account of the partnership firm. It will give you the rights and duties and liabilities of the various partners. So once all this is mentioned in the partnership deed and the partners sign off on the partnership deed, they accept and undertake to all the contents of the partnership deed. And lastly, minor cannot be a partner. A minor is a person who has not attained the age of 18, so he cannot be admitted as a partner in a partnership firm. But please remember, he can be admitted into the benefits of partnership. That means the profits that could arise from the partnership firm. So a minor cannot be a partner. A minor cannot be admitted into the losses of the partnership firm, but he can be admitted into the benefits or profits from the partnership firm. Any questions, please ask me. I request you to take about 30 seconds and read what's online, and then we will proceed. Okay. Now, what is the true test of partnership? Now there might be certain confusion, or there might be certain. Yes, Mr. Sunil, what is the last point? You have said elaborate the last point, but what is the last point? Can you please mention it here and I will explain it to you. Minor, yes. Okay, I will explain the last point to you. A minor can never be a partner in a partnership firm. A minor, okay, now who is a minor? A minor is a person who has not yet reached the age of 18. As per the Indian law, a person becomes a major when he crosses the age of 18. So any person below 18 is a minor. Yes, Sunil, under 18 is a minor. So under 18 is a minor simply because he is incompetent to contract. Like I mentioned in my sessions yesterday, day for yesterday, the people who are disqualified from entering into contracts are minors because they do not have the capacity to contract. So until 18, you cannot enter into any contracts. And please remember, partnership deed or partnership agreement is also a contract. So a minor is not allowed to do that. But at the same time, minor can be allowed to the benefits or the profits that accrue or arise from the partnership firm, but not the losses of the partnership firm. And also, he will not be allowed to be a partner until he gains majority. I hope I answered your question, Sunil. Thank you. Now, what is the true test of partnership? Now, there might be certain anomaly or confusion as to what constitutes a partnership and what does not. So let's look at the true test of partnership. The true test of partnership is the existence of mutual agency relationship, that is the capacity of a partner to bind other partners by his acts done in the firm's name and be bound by the acts of the other partners. Now, what does this simply mean? Please remember, when A, B, C, D come together and become partners in A, B, C, D and Co., each one of them, unless agreed upon differently in the partnership deed, can conduct business on behalf of the partnership firm. So when they conduct business on behalf of the partnership firm, they will also enter into agreements and contracts on behalf of the firm. Yes, so when they enter into agreements and contracts on behalf of the firm, they are binding the other partners also by their actions. For example, if again, let's come to the furniture business again, ABCD form a partnership firm to conduct a furniture business. So A is the person who is in charge of procurement. Procurement means purchasing. So he goes to the vendor and he purchases a lot of hardware items, a lot of timber and other things required for manufacturing of furniture. So excuse me, by agreeing with the vendor on the purchase terms and the purchase order, he is also binding the other partners by his actions. So, needless to say, the partners have to be completely transparent and honest with each other and conduct the business in their own interest and in the interest of all the partners put together. Okay, so next point, sharing of profit is an essential element of partnership, but it is not a conclusive proof of partnership. Now, yes, partnership, profit sharing. Yes, Mr. Shiv, I will answer your question in due course. Thank you so much. Sharing of profit is an essential element of partnership, but it is not a conclusive proof of partnership. Now, while A, B, C, and D could be partners in a firm, it's not necessary that they need to have a profit sharing. A partner can be in the firm even without a profit. So, existence of a profit is not the sole mirror to show that a partnership exists or not. A person can also be a partner in a firm without a share in the profit. Sharing of profit is prima facie evidence. Okay, yes. So when you read a partnership deed, when you look at the profit sharing ratio, you get a brief idea, or prima facie, you get to know that, okay, this is a profit, this is a partnership deed in which the profits are so and so for each partner. Thus, partnership can be presumed when there is an agreement to share the profits of the business and the business is carried on by all or by one of them acting for all. Like I said earlier again, there has to be a business, there has to be profits, there has to be profit sharing, and the business has to be carried on by all or by one of them on behalf of all. Any questions, please ask me. I will be happy to answer them. Mr. Shiv, any questions? Okay, now let's go to the next concept, that is the types of partners. Now there are 5 types of partners. One is a sleeping partner or dormant partner, a nominal partner, partner in profits only, working partner, partner by holding out. So before we move ahead, please remember, like you have different form of companies and organizations, you also have different types of partners who are present in a partnership firm. There could be a sleeping partner, a nominal partner, a partner in profits only, a working partner, and a partner by holding out. So let's move to the next slide and actually see what each of them means. Okay, types of partners. A sleeping partner or dormant partner. Now, before we get into the slide and read the slide, a sleeping partner or dormant partner is simply a person who does not take active involvement or work into the day-to-day working of a partnership firm. He is dormant, or for another matter, he's sleeping as far as the partnership firm is concerned. He does not contribute, or he just contributes, but he does not take care in the day-to-day, in running the day-to-day affairs of the firm. But he does get a profit, and he also contributes to the firm. Well, that again is an agreement between the partners as to whether someone will work, take care or take part in the day-to-day affairs of the firm or not. And if the partners decide that they just need the contribution from one of the partners, but the day-to-day affairs of the firm will be handled by another partner, they agree on that, and that is included in the partnership deed. So they share profits and losses and are liable to third parties for all acts of the firm. They are, however, not required to give public notice of the retirement from the firm. So the last part of the definition or the content says they are not required to give notice. Now, what does this mean? This is a concept which I will talk about when I talk about deconstitution of partnership firm. So a sleeping partner, like I said, it does not take active involvement in the running the day-to-day affairs of the partnership firm, but he has a share in the profit and loss, and he may or may not have contributed to the capital of the firm based on the agreement between two or more people, which is documented in the partnership deed. Now, when a person retires from a partnership firm or leaves a partnership firm due to any reason, it could be due to ill health, could be due to continuous losses, it could be due to personal problems or whatever. If he leaves a firm, partnership firm, he's said to have retired from the partnership firm, and he's supposed to give a public notice of his retirement or leaving the firm, and only then does his liability cease. Otherwise, he will be liable for acts of the firm done even after his retirement, just because he did not give a public notice. So giving of a public notice whenever a person leaves a partnership firm is very important, because your liability then ceases there. Okay, any question on sleeping partner? Okay, now, what do you mean by a nominal partner? A nominal partner is simply a person who renders his name without any real interest in the partnership firm, is called a nominal partner. He is not entitled to share the profits of the firm, neither he invests in the firm nor takes part in the conduct of the business. He is, however, liable to third party for all the acts of the firm. Okay, now let's say the partnership firm is into cooking, or into cooking apparels and cooking vessels and cooking apparatus. So in that case, it could be possible that they get Mr. Sanjeev Kapoor as a person, as a nominal partner, and tell him to be a nominal partner in the partnership firm. Now, like the content says, he does not contribute to the capital, neither does he have a share in the profit or losses or whatever. But he gives out his name that, okay, I am a nominal partner in this firm, ABCD and Co. And I'm associated with these people. Now, why do you think this is done? This is simply done so that the brand name or the image of Mr. Sanjeev Kapoor, who's a leading chef, world leading chef from India, is taken advantage of by the partnership firm. So that means that is a nominal. He's a nominal partner in ABCD and Co. He's not a sleeping partner. He's not a partner by holding out or a working partner. He's only rendering his name and nothing else. Now you might ask me, okay, just for rendering his name, what does he get? Yes, he does get an amount which is fixed up in the partnership deed or an agreement with the partnership firm. For rendering his name, he does get a royalty or a similar amount, which he takes back home, but he does not take back any share of profit or losses from the partnership firm. Now, if you read the last part of the content, it says he's, however, liable to third parties for acts of the firm. Now, what does this mean? Now, please remember, if any person in good faith has believed Mr. Sanjeev Kapoor or the representation made by the partnership firm of being associated with Mr. Sanjeev Kapoor and has made losses to such a innocent stranger or outside person, then that outside person can hold Mr. Sanjeev Kapoor liable for any losses that he might have faced. Because Mr. Sanjeev Kapoor was made as a nominal partner purely based on or because of his link to the cooking industry or he being a chef. So I hope I answered that. I hope I made that very clear, that even though he does not contribute to the firm, even though he does not take share in the profit and loss of the firm, but he will be liable to third people or third parties on the acts of the firm if the third people or third persons have done anything relying on his association with the firm. I hope I'm clear. If anyone has any doubts, please ask me. Okay, let's move on. Now, next type of partner is partner in profits only. A partner who is entitled to share the profits only without being liable for the losses is known as the partner in profits only, and also liable to third parties for such acts of the profits only. Now, like I said, a minor cannot be a partner in a firm, but he is entitled to the benefits that arise from the partnership firm. So he is an example in which he is a partner in profits only. Similarly, there could be other people where in a partnership firm where the firm might introduce or bring in people who they explicitly agree that yes, this guy is going to be a partner in profits only because his image or his name or something is going to get us profits. So he's not going to take part in the losses. He's not going to contribute anything. But yes, whenever the firm makes any profits, we will pay him. This could also be a reason if a person holds any special technical knowledge or any specialized knowledge which helps him give an advantage to the firm over other competitors or other people in the industry. So that is a partner in profits only. And again, the last part of the content says that he's liable to third parties for all acts of profits only. Similar to the earlier types, that is sleeping partner and nominal partner, a partner in profits only will also be liable to third people or to outside people or third persons in case they incur any loss by depending or working in good faith about his being associated with the firm, partnership firm. Then he will be liable to the third person along with other partners of the firm. I hope I'm clear. Okay. Partner by holding out. Partnership by holding out is also known as a partnership by estoppel, where a man holds himself as a partner or allows others to do it. He is then stopped from denying the character he has assumed upon the faith to which creditors may presume to have acted. Now, please remember, the partner by holding out is not a person who's entered into a partnership deed with the partners, who is not officially associated with the partnership firm, but due to his actions or due to his conduct, he gives an image to the people who are working with the partnership firm that he is also associated or working with the partners and the partnership firm, will be held out or deemed to be a partner by holding out. Let's say, for example, if a person comes on air, a big celebrity comes on air and says, "Oh, I am a partner in so and so firm, and this firm makes excellent and durable furniture or computers. Please purchase it from them." Now, even though he has not officially entered into a partnership with that firm, but he has openly made it clear that he is a partner in that firm and he knows that firm and its activities very well, and he's also vouched for the quality of products that the firm manufactures or produces. In such a case, if any person relying on such a representation incurs any losses, then the person who became a partner by holding out or who represented himself to be a partner of the firm will also be liable to such a person who's acted in good faith on such reliance that that person is a partner in the firm. He later cannot say that, "No, I'm not an official partner in the firm, and I just said it." But because he said it, someone has relied on him and incurred losses. So he will be liable for it as well. Yes, Mr. Shiv, you have a question. Please repeat the second one. Is it a nominal partner? Is that the one you want an explanation on? What is a nominal partner? Okay, a nominal partner is a person who lends his name to the firm. Now, please remember, like the contents goes, now a nominal partner is simply a person who lends his name to the firm, saying that, "Yes, I am associated or I am a part of this firm, and please rely on me and work with this firm." In such a case, he does not have any real interest in the firm, but is called a nominal partner. He is not entitled to share in the profits of the firm. Neither he invests in the firm nor takes part in the conduct of the business. He is, however, liable to third parties for acts of the firm. So, like I said earlier, a nominal partner is simply a name-lending partner to the firm who does not have real interest in the firm. Whether he's a celebrity or not, he could be a celebrity, he could not be a celebrity as well. But if someone just wants to be associated with a firm and wants to be a partner in a firm to share his expertise or to share his knowledge, he can be a nominal partner. I hope I answered your question, Shiv. Thank you so much. Anyone else? Any question? Now, if you notice, I have spoken about 4 kinds of partners. I have not spoken about the 5th kind. The 5th kind of partner that we missed out was a working partner. Like the name goes, a working partner is simply a person who takes care or is actively engaged in the day-to-day affairs of the firm and who runs it for his own interest and on behalf of other people as well. So like the name goes, a working partner is a person who has interest in the firm and who conducts and takes care of the day-to-day affairs of the partnership firm on behalf of all or one of the partners of the firm. That again is determined by the partnership deed. Now, if you think why does he do that? Of course, in return, he might be charging a remuneration to the partnership firm, which the partnership firm pays him for taking care of the daily affairs of the firm. So the types of partners are sleeping partner, dormant partner, nominal partner, partner in profits only, working partner, partner by holding out. Any questions on this topic, please ask me. I will be happy to explain. Or else we proceed. Yes, Mr. Shiv, you have another question. Please explain unanimity of consent. Okay. Now, like I said, unanimity of consent is a very important and essential feature of a partnership deed or a partnership firm. What do you mean by unanimity of consent? Unanimity of consent simply means unless until the partnership deed speaks otherwise, all the matters in a partnership firm should be decided with the unanimous decision of all the partners. By unanimous, I mean 100% of all the partners should agree upon a matter. If even one of them disagrees, then there cannot be said to be unanimity of consent. Okay, now let me give you an example. Let's say there are 4 partners A, B, C, and D who are carrying on the business of textile, import and export, or manufacturing of textile. Now, so far these guys have been manufacturing textile and selling it in India. The business is doing very well. But suddenly now 3 of them, A, B, and C, want to expand. They want to actually go international and export their textile material. So now for this, they do not have adequate capital. Now for this, they will have to go to the bank, take additional loans, give a personal guarantee, give a collateral as guarantee, and all those risks, and take money, and then start their exporting business by increasing their production capacity. So when the proposal was made, A, B, and C sit down and make the proposal, but then they go to D and they say, okay, this is what we are planning to do. We are planning to expand and go to generate an export business. And for this export business, we will require an X amount of money, which could be multiple crores. The base depends on the requirement. Now, if D does not agree to it, or if D finds the proposal very risky, D has the right to say no to the proposal. If D says no to the proposal, A, B, and C have to listen to it and respect it and try to convince him. They cannot override his decision and start off a business in which there is no unanimous consent by all the partners, unless until the partnership deed talks otherwise. In case the partnership deed said any new decision or any new business can be done with the consent of majority of the partners. In that case, if A, B, and C have agreed on to something, they become 75% of the partners in the partnership firm, and they can carry on that business, and they do not really require the complete consent of D. But if nothing is mentioned, then it has to be due to the unanimity of consent of all the partners, and the dissenting partner can seek legal remedies. So, Mr. Shiv, I hope I answered your question. Yes? Okay. So, we have discussed the type of partners. I'm sorry, prima facie. What is your question then, Mr. Shiv? What is the question? Do you want to know what do you mean by prima facie? Do you have another question, Mr. Shiv? Prima facie, what do you mean by prima facie? Hi, Sakshi, what do you want me to repeat? Which topic do you want me to repeat? Okay, Mr. Shiv, your question is what do you mean by prima facie? Prima facie is a legal term, and prima facie simply means on the face of it. On the face of something at first look, what does something look like? So prima facie, when you look at a partnership deed and there is, or you look at a document in which A, B, and C are mentioned as partners, and A, B, and C share the profits in the ratio 30, 30, and 40%. So prima facie, you can say that that's a partnership deed document initially. Unless and until you dig too much into the document and you find it something else, a prima facie evidence is good enough to see what a document or what something really is. So prima facie means from the face of it. From the face of it, what appears. That's a legal term. Okay, can we continue? Okay, now let's talk about the kinds of partnership. Now, please remember there are four kinds of partnership. Like we saw in the terms of types of partners, there are four kinds of partnership. So that's broken up into two parts. On the basis of duration, that's partnership at will and partnership for a fixed period. On the basis to the extent of the business, there is general partnership and there is particular partnership. Now, before we get into the details of what each means, let's just quickly discuss as to what each means. Now, partnership at will. Now, like the name says, partnership at will simply means this partnership firm is dependent on the will of the partners. That as long as the partners will or are willing to continue the partnership firm, they can do so. And in case someday they decide that they do not will or they do not have the willingness to carry on the partnership firm anymore, in that case, based on the procedure mentioned in the partnership deed, they can apply for or intimate about their intention to stop a partnership firm or dissolve a partnership firm. So I repeat again, a partnership at will is a partnership firm in which it's the partner's will as to how long they want to keep the partnership firm and for what purpose. Secondly, partnership for a fixed period. Now, there can be certain instances where a partnership firm right at the beginning is made for a particular period. Like, for example, now, let's take, for example, the COVID situation. Now, since COVID lockdown was announced in March, I mean, a lot of business were affected and a lot of livelihood and routine things of people were affected. So in this case, let's take an example for a partnership for a fixed period. So let's say if a person suddenly wanted to tap into the opportunities, of the situation, that is the COVID situation. So according to you, what was the item or commodity that was sold most or is still sold most during the COVID period? Your thermometers, your gloves, your masks, your hand sanitizers. So during this COVID situation in the month of March and April, I personally came across a lot of other people also who left their normal business, obviously because it was not working at that point, and who formed a partnership or a proprietorship firm to take advantage of the COVID situation to buy and sell hand sanitizers, thermometers, masks, and other things to keep people safe, the PPE kits. So in that case, there were a lot of instances where people made a partnership firm for a period of maybe 6 months or 1 year, and they said, okay, the COVID is going to take about a year for going down, so let's carry on business, or let's carry on this partnership business for a year. In that case, if they have made a partnership period for a fixed period, please remember at the end of that fixed period, your partnership firm will automatically stand dissolved or end. So if a partnership firm is at will, then it depends on the will of the partners as to how long they want to continue it. But if a partnership firm is made for a fixed period, at the end of the fixed period, the partnership firm will come to an end unless and until it is extended further by mutual consent of all the partners. Next, on the basis to the extent of the business, general partnership and particular partnership. Now, general partnership simply means it is a partnership firm in general. That means it can carry on a lot of businesses or a lot of activities in general, which were agreed upon by the partners and and it just goes on. Whereas a particular partnership is a partnership which is done for a particular purpose. It is right from the onset. That partnership firm has come into existence for a particular purpose, and once that particular purpose or objective is fulfilled, then the partnership firm will come to an end unless it is extended by mutual consent of all the partners. Now, let's take an example of a particular partnership. Let's say a partnership firm is done. Let's say a person is a builder, and his expertise is in providing manpower and other things, and he assists in building buildings, but his expertise is only in manpower. Whereas there is another person who is into all the building materials, in subcontracting and contracting all the building materials, and helps in other building processes. Now, both of them come together, form a partnership firm because of an order in which one of the person has got to construct a big building. So obviously the person who has expertise only in labor management is not so well versed with the materials and other contracts. So the materials guy and the labor guy come together as partners and they form a partnership firm just to make that particular building. So please remember that is a particular partnership, and that partnership can be in existence only till the building is completed. Once the building is completed, the materials guy and the labor guy have to split, and the partnership firm has to come to an end, unless until it is extended by mutual consent. So that's the difference between a general partnership and a particular partnership. No, Mr. Shiv has a question. Sir, can we say that partnership at will and general partnership are similar? No. Please remember, partnership at will is on duration, as to how long they want the partnership firm to be in existence. Whereas a general partnership is on the extent of business. A general partnership can carry on any business activity what is mentioned in the partnership deed. But a particular partnership firm can only carry out the business that is specifically mentioned in the partnership deed that they have to carry out. So, whereas partnership at will is based on duration, partnership and general partnership is based on the nature of business. So there is a big difference. They are not similar in any way. I hope I answered your question, Mr. Shiv. Yes? Okay, thank you so much. Now, let's quickly go through what I just explained to you already. Partnership at will, according to Section 7 of the Act, it is a partnership when no fixed period has been agreed for the duration of the partnership and there is no provision made as to determination of the partnership. Like I told you earlier, partnership at will is where no duration is mentioned and it completely depends on the wills and desire of the partners to carry on the business for however long they want. Partnership for a fixed period, where a provision is made by a contract for a duration of the partnership is called partnership for a fixed period. Like I gave you the example of COVID-related business. If the person has made a partnership firm just for a year to take care of the COVID, to take advantage of the COVID situation and make some money, then at the end of that period, the partnership firm will come to an end. A partnership may be organized for prosecution of a single adventure as well as the conduct of a continuous business. Like I said, a particular partnership firm may be established to carry on a very specific activity, a business activity, and once that business activity comes to an end, the partnership firm also comes to an end. A general partnership firm, where a partnership is constituted with respect to the business in general, it is called general partnership. That means it wants to carry out its business until perpetuity or a reasonable period of time without any intentions of stopping, and the business will go on. So these are your kinds of partnerships that are mentioned under the Indian Partnership Act 1932. Any questions, please ask me. Okay. Now, what have we discussed so far? So far, we've discussed the essential. What is a partnership firm? The essentials of a partnership firm. We have discussed the types of partners. We've discussed the types of partnership firms. Now, let's go a little further and discuss what are the rights of the various partners in the partnership firm. Let's take it one point at a time. What are the rights of a partner to take part in the conduct of a business? Like I said earlier, unless otherwise agreed upon in the partnership deed, each partner in a partnership firm has the right to take care in the conduct of the business. He can take care in the day-to-day running of the business unless until it is agreed otherwise in the partnership deed. If something is mentioned in the partnership deed, then only that partner will be allowed to take care of the business, to share equally in the profits of the business. Please remember, your partnership deed necessarily needs to have the profit sharing ratio and the loss sharing ratio of the partners. If nothing is mentioned in the partnership deed, then it is understood that the profits and losses are shared equally among all the partners. It is assumed. To access to and inspect the copy of any books of the firm, see, a partner is also the owner of the firm, so he has the right to access any books of accounts or any other books of business of the firm at any time he wants. No one can stop him. Whether he conducts the business or not, he should be given access to the books of the firm. To be the joint owner of the property of the firm, yes, if the partnership firm owns any property By default, each partner becomes the joint owner of the property. This also has something to say about the unlimited liability. If the partner is the joint owner of a property, please remember he is also jointly liable for any debts or liabilities of the firm. In emergency, take all actions to safeguard the firm. Yes, this is another right of the partner. In case of an emergency where the situation calls for, a partner can take steps to safeguard the interests of the firm and all the partners of the firm. To resist introduction or admission of new partner, yes, admission and retirement forms a reconstitution of a firm, which we will discuss in the next session. Now, if there is any partner that is being introduced into the firm or being admitted into the firm, the existing partner has a right to resist or to raise an objection if he's got a valid objection for that admission. And then he needs to convince the other partners. Right not to be expelled. Expelled means being thrown out. So a partner in a firm has the right not to be expelled until and unless there is gross misconduct or there is gross negligence which can be proved by the other partners against him, and due to that action the firm and the other partners have incurred grave losses. In that case he can be expelled, otherwise he cannot be expelled. Sakshi, expelled means being thrown out. So I just explained that to you. I hope I'm clear with that definition. Expelled means being pushed out or thrown out of the partnership firm. Yes, Shiv, the rights might change of partners after the change in the firm. Definitely the rights, duties, obligations, profit sharing, everything changes of the partners after a change in the firm. We shall be discussing this in the next session, part 2. Okay, now what are the duties of partner? General duties: to carry on the business of the firm, to be just and faithful, to give accounts and complete information. Now, please remember, partnership is where two or more people come together to carry on a common business and share profits. So there has to be utmost transparency and trust among each partner. That is the groundwork and the foundation of the business relationship. So it is a general duty. It is a general duty to carry on the business of the firm, to be just and faithful, to give true accounts and complete information, to indemnify the firm for the loss caused by him during the conduct of the firm's business. If any particular partner was negligent or careless in carrying on the business, and due to his actions, all the other partners and the firm incurred a loss, then it becomes the duty of such a negligent partner to indemnify. Indemnify means make good or reimburse the losses what the others have suffered due to his actions. So it becomes a moral responsibility for him. Like I explained in the first or second slide, that one partner can bind all the other partners and the firm by his actions unless otherwise agreed upon in the partnership deed. To contribute to the losses of the firm in equal proportion, unless until agreed otherwise in the partnership deed, all the partners are equally liable for the losses and equally they have an equal part in the profits of the firm. Not to assign his own share to some other party. Again, he cannot assign his interest or holding in the firm. If a partner is a 25% partner in the partnership firm, without the mutual consent of all the other partners, he cannot assign his 25% interest to an outsider, because that will affect the partnership firm in an adverse manner. To attend to his duties diligently, whatever duties have been agreed upon by the partners in the partnership deed or otherwise, every partner is supposed to diligently carry on his duties and perform his tasks for the betterment and the interest of the partnership firm. The liabilities of a partner. General liabilities arise when he fails to be just and faithful to all the partners. He fails to carry on the business of the firm in the highest common interest. He fails to give true accounts, to indemnify. Like I told you in the previous slide, these are the duties of a partner. If the other partners have incurred a loss due to the negligent behavior of one partner, then it becomes his moral duty to reimburse or indemnify the other partners who incurred a loss because of him. So that also makes it his liability. So in case he because of his negligent actions, the partners incur a loss, or if he fails to give them true accounts and transparent transactions, or if he fails to give them correct explanations about his actions, or there is something fishy in his actions, then he is liable to make good that loss to the other partners and the firm. So this is the liability of the partner. Now, liability of a firm for the wrongful acts of a partner. The firm is liable in the given in the given below situations. If a loss or injury occurs to third person due to the act of a partner in the course of the business of the firm, if a partner acting within his apparent authority receives money improperly and misappropriates it, if money received by the firm in the course of business, the partner misappropriate. Now, what does this slide speak about? The slide speaks about that in case the firm, if there is any loss or injury carried on to any third party due to the partner in the business of the firm, then it is the liability of the firm, even though the wrongful acts were carried on by the partner. Please remember, the partner is working or functioning on behalf of the firm. So he can bind the firm by his actions, whether it's right actions or wrong actions. If it is wrong actions, then the firm is bound to any third party if any transaction has happened in the ordinary course of business. Then, in the ordinary course of business, if the firm or a partner acting on behalf of the firm receives money, so if your customer has to give the partnership firm some money and the customer pays that money to partner A, and partner A takes that money and runs away, then the firm is liable to the customer for that amount which A has run away. Now what happens? The partnership firm has to make good that money to the customer or give him the goods or services, and then in turn file a case against A to recover that money. If the money received by the firm in the course of business and the partners misappropriated, then in case the firm has received some money and kept it in a locker or a drawer, and one of the partners misappropriates or steals that money or misaccounts the money, even in that case, the customer cannot be held responsible. The firm has to take responsibility and liability for that amount, make it good to the customer, and then in turn recover it from the partner. So a liability of the firm is present for the wrongful acts of a partner done in the normal course of business. If it is done outside the course of business, the firm is not liable. So this would be the end of today's session, part 1. There would be a part 2 coming up very soon, which will talk about reconstitution and reorganization of a firm. So I request you all to stay tuned for that section as well, because it will be a continuation of this one. To answer Mr. Shiv, is it compulsory to learn section because I'm finding difficulty? Please remember, when you quote sections, you do not get any extra marks. But when you quote wrong sections, you certainly lose marks. So it's more important to know the contents of what a section is, and not necessary to by heart or mug up the sections. If you can remember it naturally, yes. Otherwise, it's not necessary. Please remember the content and case laws. Mr. Shiv, case study books, yes, stay tuned to my channel. I will let you know about it in due course. Thank you so much. Okay, this is Prathik Gupta signing off from today's session, that is the Indian Partnership Act 1932, Part 1. I look forward to seeing you in Part 2 soon. And please do not forget to use the code Pratik when you subscribe to the Unacademy subscription list. Thank you so much.